Welcome back. This week we're going to be covering Chapter 6, Accounting for a Merchandising Business. In Chapters 1 through 4, we looked at Net Solutions, which was a service business. And in this chapter, we're going to talk about the difference between a service business and a merchandising business. So what we want to accomplish in this chapter, by the end of this chapter, we want to make sure that you're able to distinguish between the activities and financial statements of a service business and a merchandising business. We want you to be able to describe and illustrate the financial statements of a merchandising business. We want you to be able to describe and illustrate the accounting for merchandising transactions, including sales of merchandise, purchase of merchandise, freight, sales taxes, and trade discounts, and be able to describe and illustrate the dual nature of merchandising transactions. And then finally, we want you to be able to describe the adjusting and closing process for a merchandising business. We're going to begin by distinguishing between the activities and financial statements of a service and a merchandising business. First, we'll look at the service business. Like I said, this is like Net Solutions. And you can see to compute our net income, all we do is we just take our fees earned and all of our any other revenue accounts we have, but basically our fees earned, and then we subtract our operating expenses, and we get our net income. With a merchandising business, it's a little different because we're actually selling something to the customer. So we take our sales and then subtract the cost of merchandise sold, what they bought from us, what we paid for what they bought from us, and that gives us our gross profit, and then we subtract our operating expenses, and that gives us our net income. When merchandise is sold, the revenue is reported as sales, and its cost is recognized as an expense called cost of merchandise sold, or sometimes just called cost of goods sold. Merchandise on hand not sold at the end of the accounting period is called merchandise inventory. And now we're going to take a look at example exercise 6-1. It's on page 253. And this one, they're telling us, giving us our sales. They're saying during the current year, merchandise is sold for $250,000 in cash and for $975,000 worth of merchandise on account. So if we add those two together, that'll give us our total sales, and then it tells us our cost of goods sold is $735,000, and it wants to know what our gross profit. So we take our total sales, which is the $250,000 cash sales and the $975,000 sales on account, and we subtract the $735,000 cost of goods sold, and that gives us a gross profit of $490,000. This slide just illustrates the operating cycle for a merchandising business. We start with sales, and sales become accounts receivables, and then we go through the collection process, which generates cash that we can use for purchasing products, and then we go back and those products are sold. So we have that continuous loop in the operating cycle for a merchandising business. Now we're going to describe and illustrate the financial statements of a merchandising business. Merchandising businesses do use the multi-step income statement, and it contains several sections and subsections and subtotals. And just the first part of it, we have our sales, and this is actually using Net Solutions as the merchandising business now. But in the first 4 chapters, we talked about it as a service business. So we actually convert the business, I guess, letting it evolve into a merchandising business. But you can see our revenue section of the income statements consists of sales, $720,185, less sales returns and allowances, and less sales discounts, and those together were $11,930, and then that gives us our net sales for $708,255. So our income statement becomes a little more detailed than it did for just the service business. Okay, now let's explain what a sales return and allowance is. well, first the sales account is. The sales account provides the total amount charged to customers for merchandise sold, including cash sales and sales on account. Our sales returns and allowances are granted by the seller to the customers for damaged or defective merchandise. And a good example of that, if we were selling appliances, we shipped or delivered a refrigerator to the customer, and on the way in, the delivery guy scratched it on the door, on maybe the side of the refrigerator where it wouldn't be seen, and the customer would go ahead and accept the delivery, but wanted a discount because of the scratch. That would be a sales allowance. Now, sales return would be if they actually said, no, let's say they scratched it on the front, and the customer said, no, I'm not going to pay $1,000 with a refrigerator with a big scratch on the front. Well, that would be a sales return. So they're granted by the seller to the customer for damaged or defective merchandise, or merchandise just returned to the seller. Sales discounts, however, are granted by the seller to customers for early payments of amounts owed. The typical thing that you'll see is 210 net 30, which means if you pay within the first 10 days, you get a 2% discount. And if you don't, after 10 days, you just have to pay the full amount, and payment is expected within 30 days. The cost of merchandise sold is the cost of merchandise sold to the customers. Now, don't you love that definition? We take the term itself and use it as the definition. Cost of merchandise sold is the cost of merchandise sold to customers. Just add a couple of words on the end, to customers. Now we're going to take another look at our income statement. And we've got our sales less the returns and allowances and the discounts, giving us our net sales of $708,255. Then we compute our cost of merchandise sold, and we come up with $525,305. And then that would be subtracted from those net sales. The buyer may return merchandise to the seller, and that's called a purchase return. Or the buyer may receive a reduction in the initial price at which the merchandise was purchased, called a purchase allowance. So we take our sales returns and allowances, and if we look at it from the standpoint of the purchaser, it's called a purchase return or purchase allowance. So it depends on the perspective. As you have seen how sellers may offer customers sales discounts for early payments of the bill. From the buyer's perspective, such discounts are referred to as purchase discounts. So a sales discounts to the seller is a purchase discount to the buyer. If the merchandise inventory at the end of the period is determined by taking a physical count of inventory on hand, that's called a periodic inventory system being used. The other system of inventory we can use is called the perpetual inventory system of accounting, and the amounts of the inventory available for sale and sold are continuously or perpetually updated in the inventory records. Most businesses that are highly evolved, using a lot of technology, you'll see them using a perpetual inventory system because it works great. You know, you can actually have it where it'll tell you when you're out of merchandise, when you need to show you reorder points and all of that. This is our cost of merchandise sold, and this is a separate schedule, usually from the income statement. But we start with our beginning inventory, and then we take and add in our purchases, less the purchase returns and allowances, and less the purchase discounts, getting our net purchases. Then we add in the freight, and that gives us the cost of merchandise purchased. So we add that to the beginning inventory, and that gives us merchandise available for sale. And then we subtract our ending inventory, and that gives us the cost of merchandise sold. And I'm out of time, so we're going to stop right here, and we'll pick back up in just a little bit. Thanks, and I hope you have a great day.